Good afternoon and welcome everyone to a very special options education session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be focusing our session on helping you understand how you can grow your options account trading, how you can grow your trading account using options. And we're going to focus our attention on one specific strategy that I'm going to show you how you can master and how you can find the best performing ideas in that specific strategy at any time using the tools that are available to you at stockcharts.com alongside with OptionsPlay. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. Now, what we're going to go over today is specifically how to grow an options account. I'm going to talk about some of the basics that, as a strategist that I've worked with clients over the last 18 years, what has consistently helped clients grow their trading accounts with regards to options trading, and why the single strategy that we're going to go over during today's session is the one strategy that I think universally can help all traders help them grow their trading accounts. We're going to talk about the simple and forgiving option strategy and why I think this is the one strategy that will help almost every investor, whether you're beginner or advanced, learn how to trade options. We're going to talk about the optimal spread, meaning what is the optimal way to use this specific strategy. And we'll talk a little bit about how you can gain an edge from an options trading perspective, how you can gain an edge from a timing perspective, and then how you can combine those two together and find the best possible opportunities in the market at any one time using our real-time trade scanner that's available to you at stockcharts.com through the OptionsPlay add-on. And then ultimately, we're going to show you a little bit on how to manage these trades once you have one of these trades on. So we're going to try to go through everything fairly quickly here today to help you better understand how you can utilize these specific strategies for your account. So let's go ahead and get started here. Now, but the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you use, how can you generate consistent income in any market condition using credit spreads. So today we're going to focus our attention on helping you understand how to utilize credit spreads to consistently generate income in your portfolio and grow your account over time. Okay, so to kind of start off and helping you better understand, I want to first kind of provide you some of the color on my experience as an options market strategist over the last 18 years and what I have seen generally help customers and clients grow their accounts in the long run. So first and foremost, and this is probably something that a lot of traders who simply just choose to subscribe to someone else who says, I'm a successful trader. If you just follow my trades, you'll be successful at all. That strategy usually doesn't work because you don't have a fundamental understanding of how that specific strategy has an edge. You're just following signals. It doesn't matter whether the signal tells you to buy or sell and what it tells you to buy or sell. You're just following something blindly. And what that doesn't teach you is understanding kind of the process and understanding how something has an edge. So as soon as you go through a string of losers, you tend to jump ship. You tend to lose confidence just because you have no real understanding as to why it's having some losses in a row. And any strategy, there's always going to be a period of time where a strategy might underperform. And if you don't have a fundamental understanding of how that strategy works, you're not going to be able to survive through that. So first and foremost in terms of being successful in growing your options trading account, you have to have a fundamental understanding of how a strategy has an edge. And that's what I'm going to show you here today. How do you gain an edge on the options trading side? And how do you gain an edge from a timing perspective? Those are two things that we're going to combine together to help you find the best possible trading opportunities. The second part, which is not a requirement, but I do tend to find that traders who trade strategies that has a winning percentage that's greater than 50% just tends to have an easier time to manage their emotions and to manage kind of the process for learning how to improve themselves as traders. There's plenty of ways to be profitable with win rates that are less than 50%. It's just emotionally much harder to kind of psych yourself up and motivate yourself to continue to improve and get better when your win rate's less than 50%. So I'm going to show you today a single strategy that naturally on its own is going to have a win rate greater than 50%. It's going to give you kind of that extra mental ability to want to improve and get better and get yourself onto the path of profitability. And third of all, we want to prevent blowups. I'm going to talk to you a little bit about how to make sure that you prevent those account blowups, because first and foremost, in order to be profitable, you have to make sure that you stop blowing up your accounts. And I'm sure most of you here probably have some can relate to these issues in some way, shape, or form, either lack of confidence, lack of consistency in your trading, or you've just found yourself blowing up your account either once or multiple times in your history. If you can relate to that, please type 1 into the chat window if you can relate to any of these things, because these are the things that I've seen in my 18 years of doing this have prevented a lot of traders from being successful, and a lot of traders kind of give up on trading. So what I want to do is try to, in a 30 to 45 minute session, try to address some of these things and help put you onto the right path of profitability. Okay, so let's see, is this all right? Hopefully that looks a little better here. So today what we're going to talk about is our credit spreads. It's a simple and forgiving strategy. So a credit spread, for those of you that may not know what that is, it's an income generating option strategy for what we consider as a mild directional view. What do I mean by that? Is meaning if you can look at a chart and generally plot a overall trend for the stock, whether it's trending higher or trending lower, that's all you need to have in order to potentially sell a credit spread. There are a lot of other option strategies that require far more of an outlook before you can utilize those strategies. So for example, if you want to buy a call option, you have to believe that the stock is going to make a fast move in a short period of time to justify buying a call option. Or if you're buying a put option, it requires you to believe that the stock is going to plummet very quickly in a short period of time to justify buying that put option. Now, it's not every day that you come across stocks that you think is going to make a big move in a short period of time. But there's plenty of times where you're going to just look at a chart and you say, oh, that stock is trending higher or that stock is trending lower. And that is the only requirement that you generally need to consider selling a credit spread, which is why it's a far more versatile strategy for a lot more scenarios, and which is why it's something that I think most traders need to learn how to master this one strategy if you want to consistently grow your account in the long run. It's also a strategy that's forgiving. It's a strategy that has a high probability of success. That's going to help you build that confidence that we're talking about. And then lastly, it has limited risk and limited reward. And what that means is that before you get into any trade with a credit spread, you know exactly how much money you can potentially make or lose, which means that you have full control over not blowing up your account. So when you're trading credit spreads, if you ever blow up your account trading a credit spread, unfortunately, the only person you can blame is yourself, because you had full control over how many contracts you traded, and you chose to trade contracts that are well beyond your risk tolerance. So we're going to talk a little bit about that here today in terms of how do you control the number of contracts that you trade so that you stay in your lane. And so we're going to address all of these three things. How can you build your confidence in the strategy? How can you gain consistency in higher win rates? And then how do you prevent account blowups? And if you can do all three things, then you are going to put yourself onto the path of profitability. I'm going to show you how to do all of these things in today's session. So now, a credit spread. What is a credit spread? How is it built? I'm going to walk you through some of what we consider, quote unquote, the optimal credit spread. And then we're going to look at how do you get an edge from this specific strategy. So I'm going to use, this is an old example here, but it's a good example here. You know, if you look at this particular chart, it's not a great looking chart per se, but I think anyone looking at this chart can say that, you know, this stock was maybe trading sideways for a little bit of time and recently started trending higher here, right? There's not much that you need to understand about technical analysis or charting. Anyone who can look at a chart visually can generally make these generalizations. So in this particular case, you might look at selling a bullish credit spread. So when you look at credit spreads, the general rule of thumb is that you want to go out roughly 45 days to expiration. And I'm telling you these things not because you need to memorize it, but just I want to help you to understand this type of information. The tools that I'll be showing you will actually automate everything that I'm showing you here today. So even if you feel that you're not fully understanding everything here today, just remember the tools that I'll be showing you here will actually apply what I'm showing you, okay? So the general rule of thumb when we look at, and this is based on thousands and thousands of back tests that we have run on these types of strategies, testing out different various expiration dates, various strike prices, combination of strike prices to see how do you get the best results from these types of strategies. And this is a result of all of that back testing. So, you know, with every single strategy we back test, we generally get a sense for what is the optimal days to expiration to use, as well as what strike prices to use. So when we're talking about credit spreads, we generally want to go out roughly 45 days from expiration in order to maximize the income generation part while minimizing the overall risk on the overall trade. And then when you're trading a credit spread, what you're trading are two strike prices of that individual stock. So in this particular case, I was using Baidu as an example. And at the time, Baidu was trading at $97. What we want to do is we want to sell an at-the-money strike price. So when you're selling a credit spread, because you're selling, you basically take the exact opposite approach as if you're buying. When you're buying, calls are bullish, puts are bearish. But when you're selling, the opposite, puts are bullish, calls are bearish, okay? So whenever we're looking at a bullish credit spread, we're looking at the bull put spread. So what we want to do is we want to sell an at-the-money put when we have a bullish view on a specific stock. So in this particular case, what we're going to do is we're going to sell the $97 put option because the stock is trading at around $97.50. And what we're going to do is we're going to buy an out-of-the-money put against the puts that we sold, because if we just sold the puts and that's it, it's going to require a lot of capital. It's going to take on a lot of risk in order to do that. And we don't want to tie up a lot of capital, and we don't want to tie up a lot of risk on a specific trade. We want to limit the amount of risk, and we're going to do that by buying a put option against the put option that we sold. So in this particular case, we want to buy what we call a 25 delta put option. If you don't know what that means, that's okay. A 25 delta put just means that we're picking a strike price where there's about a 25% chance the stock will be below that price at expiration. So for Baidu, at the time, the $88 put was going to be the 25 delta put option. So in this particular case, what we're doing is we're selling the $97 strike put option, buying the $88 put option. And the goal here of an optimal credit spread is we want to collect at least 1/3 or 33% of the vertical width. The width is the distance between these two strike prices. Whenever you trade any vertical spread, there's two strike prices. In this particular case, 97 and 88. The difference between those two numbers is $9. And what we want to collect is roughly 1/3 of that vertical width. So 1/3 of $9 is $3. In this particular case, we're actually collecting $4 on this vertical spread. we're selling this vertical spread for $4. And because each contract represents 100 shares, $4 equates to $400 in income that we're collecting on this credit spread. And the thing that you have to remember about any vertical spread, whether it's a debit vertical spread or a credit vertical spread, is that the distance between the two strike prices, whatever you collect in income or whatever you can potentially make on the trade, the rest of that vertical width is going to be your risk. So the relationship between risk to reward is always going to be as a distance between the two strike prices. So if you have a $9 wide credit spread and you're going to collect $4 on income, then $5, the remaining $5 is going to be your total risk. And what that means is that the more you collect in income, the less you risk. The less you collect in income, the more that you risk. So the goal here, whenever we're selling credit spreads, is we want to collect at least 1/3, meaning 33% of the vertical width is income, which means that the maximum risk that we want to take on it is going to be 2/3 of the vertical width. Okay, and I'm going to use some round numbers to help make this point a little bit clearer. Okay, so for example, if we were to sell a credit spread that is I'm going to use round numbers to make this really easy, right? Let's say we sold the $100 put on let's say we have a stock that's trading out. Let's say we have a stock that's trading at $100. Okay, just to make it nice and easy round numbers, and we sell the $100 put option on this $100 stock. So we think the stock is going to go higher. We sell the $100 put. But if we just sold the $100 put, we would need roughly $10,000 in order to do that per contract. That's a lot of money that you need for just to sell one contract. Not to mention, you're technically taking on $10,000 worth of risk if that stock went to zero. We don't want to do that. So what we're going to do is we're going to buy a $90 put against that. And what that's going to do is going to reduce the entire margin requirement from $10,000 to $1,000. That's something I think most people can manage in terms of total risk, right? So your risk is actually reduced in this particular case. So when I said before, if let's say you sold something at a $100 strike and then you bought the $90 strike, the distance between those two strike prices is $10. That's the most that you're effectively playing with. So whatever you collect out of that $10, the rest of it is going to be your risk. So if you collect a minimum, which is 33% of the vertical width, that's $3.33 out of the $10. If you collect $3.33, the rest of it, which is $6.67, is going to be your total risk. So if you collect $3.33, then the rest of the $10 is going to be your total risk. That's a risk to reward ratio of 2 to 1, meaning for every $1 you can potentially make, you are risking $2 on the back end of that, right? So that means that you need 67% of trades like this to be winners in order for you to be profitable. Now, just to kind of play this scenario out, let's say you have 2 trades where you win $1. You have 1 losing trade where you lose $2. You have 2 winning trades where you win $1 each. You have 1 losing trade where you lose $2. You have 2 winning trades where you win $1. You have 1 losing trade where you lose $2. If you continue this cycle over and over again, where do you end up? Type your answer into the chat window. If you just keep repeating this cycle where you win $2 at a time, lose $2, win $2, lose $2, what do you get at the very end? Break even, right? A big fat 0. A lot of people say, well, what's the point of doing something if the whole goal of it is to be at 0? Well, what I tell a lot of traders who are struggling right now is that most traders don't even get to break even. Most traders are underwater. Most people are below break even. So the goal here is to make sure that you set a minimum of just breaking even. That's the minimum. You obviously want to do better than breaking even, but you want to make sure you set the minimum. But before we kind of explore how to get better than breaking even, I just want to make sure everyone understands the concept of whatever you can potentially make, the rest of it is going to be your risk, and the relationship between what you can potentially make versus what you can potentially risk. That relationship is really important you understand that, because once you understand that, well, then we can look at how to actually improve and how to get beyond break even, get to profitability. Does that make sense, everyone? Please type 2 into the chat window if the relationship of what you can potentially make versus what you can potentially lose makes sense to you, because it's really straightforward, right? Anytime you sell a credit spread, there's 2 strike prices. Whatever you make, the rest of it is what you can lose, okay? So this is what I consider the optimal credit spread, or rather the bare minimum of what you want to choose when you're selling a credit spread. But what you're actually going to find, or rather what our tools can help you find, are opportunities where the option pricing is skewed in your favor. What do I mean by that? Is that there will be times where when you sell that $100 put and then buy the $90 put, instead of collecting $3.33, you might find yourself collecting closer around $4. If that's the case, $3.33 and $4 doesn't sound too big of a difference. But if you collect $4 out of a $10 wide credit spread, then the total risk on that trade reduces from $6.67 down to $6. And that means that now you're collecting 40% of the vertical width, which means that your risk is only going to be 60% of the vertical width. That skews your risk to reward ratio now to 1.5 to 1. So if you repeat that same cycle again, where you have 2 winning trades where you win $1, you have 1 losing trade where you lose $1.50, you have 2 winning trades where you win $1, 1 losing trade where you lose $1.50, and you repeat that cycle over and over again, now you have a winning formula. Now you only need 60% of your winners in order to break even. So if you do have 62, 63, 65, 67% winners, then you're going to be profitable in the long run. But it requires you to find trades that look like this, where you are collecting more than 33% of the vertical width. And I'm going to show you how to do that. Okay. But before we show you how to do that, it's important that you understand fundamentally how the strategy works. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay. So we're talking about the first half of the equation, which is how do you identify option trades that give you an edge, meaning where can you skew the risk to reward ratio as far in your favor as possible and make sure that you only trade trades where they're skewed as far in your favor as possible. But there's a second part of this that you can optimize even further and skew the possibilities further in your scenario. And that comes from timing. Okay. So before I said that credit spreads, you can trade credit spreads basically anytime you identify that the stock is sort of in a directional, moving in one direction or another, right? So if you can look at a chart, as you can see, this chart has no technical indicators on it. I don't have moving averages. I don't have stochastic. I don't have anything. I'm just looking at price. If you can read a price chart, you can generally have a good sense for when you can sell a credit spread. And if you look at this stock, it doesn't really matter what the stock is. Basically, throughout this entire time would have been an okay time to sell a credit spread. And even when I consider kind of the worst cases, the worst time to sell a credit spread, you can still be profitable in this specific strategy. However, there are good times, there are better times and okay times to sell credit spreads. So for example, if let's say I'm looking at this particular chart, right, and the stock has made a big run here, and I'm thinking to myself, this is definitely a bullish stock. It recently just made a new high. It's all things are pointing to this stock is going to continue moving higher. I'm going to sell a bullish credit spread. You very well could be profitable using that strategy. So let's just say at this particular candle, right here, I'm going to draw a little circle here, a little dot here. Let's say I sold a credit spread there. Would you be profitable selling a credit spread there? The short answer to your question is likely yes. But after you sold the credit spread, you would have sat through a little bit of chop here. You would have had a few days where it was a little bit profitable, a little unprofitable, a little profitable, a little bit unprofitable, and eventually it turned profitable and you would have potentially turn a profit on this particular trade, right? But you would have sat through perhaps a few weeks of chop, some small gains, small losses, and then eventually turn into a profitable trade. Same thing here. If you saw that the stock had made a big move, made a new high, everything is pointing up to and potentially continuing, and you were to sell a credit spread on this specific day, would you be profitable? Yeah, but you would have sat through maybe a couple of weeks of chop, where you had a small gain, small loss, small gain, small loss, and eventually the stock moved back in your favor and you would have been profitable. And the great thing about credit spreads is that even if the stock just trades sideways, you can still make the full profit on the trade. That's really the forgiving nature of this specific strategy. However, if you were to time these trades properly, meaning if you were identified a bullish trend and you waited for pullbacks in that trend, then if let's say you were to buy, if you were to sell the credit spread, let's say at this stage, right, where you waited for the pullback on this particular dot, then you would have been profitable within perhaps just a couple of trading sessions, and you could have potentially made 50, 60, 70% of the max profit on that particular trade, perhaps in less than 5 trading sessions. So while you could have sold the credit spread pretty much at any point throughout this year and been profitable, there's probably just maybe a couple of times where maybe if you sold the credit spread, maybe if you sold the credit, if you were somewhat unlucky and you sold the credit spread there, that was probably the one instance throughout the year where you would have been unprofitable because the stock pulled back, it kept pulling back, and even when it kind of came back, right, it took probably more than a month in order for it to come back. And maybe you would have eventually at the end, even in the worst case scenario, turned a profit on this particular trade, but you would have had to sit through quite a bit of pain in order to get there. And you might have at some point maybe stopped yourself out and said, hey, this trade's not working out, I'm going to get myself out. So even in kind of your worst case scenario, you're still likely to potentially turn a profit on this trade, but the timing on it makes a big difference between whether you're profitable immediately or if you could be sitting for a month before that trade turns profitable. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. So we can optimize trades from an options trading perspective to try to find trades where the risk reward is most favorable in our favor, but we can also optimize this even further by timing these trades correctly. And when we time this correctly and you combine those two things, that's when you have a recipe for growing your account consistently in the long run. Okay. And you can do this for both bullish and bearish entries. So the same stock, this is the same stock, but on the downside, right? If you were to, let's say, identify, hey, let's say at this stage, right? Let's say at this stage, you started to identify, hey, this uptrend has been broken. Clearly, there's some support levels that, were potentially holding below before has now been broken. And now you're saying to yourself, okay, this trend has turned from bullish to bearish. Let me now look at selling bearish credit spreads. And let's just say you were, at this stage, you found that, okay, we made a new low. The trend has changed. Let me start selling some bearish credit spreads. Would you have been profitable on a bearish credit spread if you entered it at that stage? The short answer to your question is likely yes, but you would have sat through a few weeks of potentially some small losses before the trade ended up ultimately working in your favor. And just like the bullish examples, you have better opportunities where once you've identified a bearish trend, waiting for rallies to then sell into, because if you were patient and waited for that rally, that's when you would have been profitable almost from the very beginning. Immediately, you would have been profitable. And then within probably a couple of weeks, you would have made 70, 80, 90% of the maximum profit on your trade in a very short period of time, rather than waiting potentially a month just to eke out, perhaps, a profit at the end of the month, versus you could potentially be profitable in just a few days or a couple of weeks if you time your trades correctly. Okay. So everything that I've taught you here today is to kind of help you better understand what do you need to look for in this specific strategy to skew as many things in your favor as possible. on the options trading side and on the timing side, which begs the question, how do you find trades like this every single day? Now, you could sit there and manually look through charts and identify when the stock has rallied to find the right timing, and then pull up an options chain to see if you can, identify a credit spread based on the best practices that I taught you, manually looking at an options chain to say, okay, what's the at the money strike? What's the 25 delta strike for 45 days out? Am I collecting 30% of the width, 35% of the width, 40% of the width? You can do all that work manually, but I'll tell you, that's going to take a long time, and you're going to be spending all day long looking for opportunities, and you might not be able to find the best opportunities because you're doing it manually. And that's really where the OptionsPlay Strategy Center within Stockcharts comes into play. Now, the OptionsPlay Strategy Center within Stockcharts is a premium tool that costs $40 a month, but hopefully what I'm going to show you here today is how this tool automates both steps for you in real time. And I want to try to cover your monthly subscription on your first trade. So let me show you how this tool works. This is the OptionsPlay Strategy Center inside of your Stockcharts account, right? So if you go to your Stockcharts account, once you log in, under scans and alerts, you will see, under charts and tools, you'll see under the options section, the OptionsPlay Strategy Center. You can also access the OptionsPlay Strategy Center directly from your dashboard. So multiple places that you can access this, either under charts and tools, under the options section, or under the OptionsPlay Strategy Center. Now, when you go to the OptionsPlay Strategy Center, the first thing you're going to see are these trade scans and chart lists. So we have pre-built trade scans for you, and you can also access all of your chart lists. So for this tool, for this specific trade setup that I'm showing you, what we generally want to look for are bullish trend following trades and bearish trend following trades. So depending on whether you're bullish on the markets or bearish on the markets, you might want to skew to, which one, or maybe you're tactical in the markets. So in the current market environment where the S&P is making new highs, pretty much most indicators, underlying indicators in the market are pointing towards more bullish positioning. I would prefer to look at bullish trend following opportunities. And what you're going to do is you're going to select a strategy. And in this particular case, we're going to look at a bull put spread. That's going to be the bullish credit spread that we refer to during today's session. And as you can see, what this is going to do is it's going to automatically populate for you the time frame and the risk profile. And those are the faults that I was showing you before, right? So, in this example where I was showing you the optimal credit spread is going out 45 days, and selling the at the money and buying the 25 delta call or put against it. That is going to be the default settings when you select a bull put spread or a bear call spread. A bear call spread is just the bearish credit spread. A bull put spread is the bullish credit spread. So whether you select either one of those, we will default for you the 45-day time frame and the aggressive risk profile, which is based on our best practices and our back testing shown to be the best parameters for this specific strategy. So it automates everything for you. And what the Strategy Center is doing is it is finding for you, what the Strategy Center is doing, it's doing all of the work that I just showed you. It's finding credit spreads that generate more than 33% of the vertical width, and it ranks it for you so you can see which credit spreads has the highest or the best risk to reward ratio. And it's only going to show you stocks or ETFs that have generated a buy or sell signal, because we're only looking at stocks that have triggered that bullish trend following signal. And the third thing we look for is liquidity, right? And anyone who's traded options for a while knows this, because you probably have come across great ideas. You scan for trades, you look for technical setups or fundamental setups or whatever it is that you're looking for, and you find these great stocks, And then you pull up the options chain and you realize that, either there's no options traded or the options aren't very liquid. And you've done all this research just to find trades that you can't actually execute from an options trading perspective. So we only look at all three things, and only when all three things are triggered does it show up on the list for you. So this makes it incredibly easy for you to find all the criteria that I just taught you during here today in real time, all at your fingertips without doing any additional work. You don't have to do any of the manual work. So let's take a look at some of these, right? So I just chose using our strategy center, looking for stocks that have triggered a bullish trend following signal. So those are the optimal times to get into these particular trades. I'm selected the bull put spread, which is the bullish credit spread, and it automatically defines for me what is the optimal settings for that bullish credit spread. And then what you can do is you can change this max risk based on your account size. My rule of thumb is that you don't want to risk more than 2% of your total account value on any given trade. So let's say you have a $50,000 trading account, then you want to select $1,000 as your max risk. You have a $100,000 account, you want to select roughly $2,500. You just want to select a range that closely matches your portfolio size. And like I said, 2% of your total account value is generally the target that you should shoot for. And if you do that, you're going to prevent account blowups, because no single trade, even if the trade goes 100% against you, then the most you'll lose is 2% of your account. And you can always survive a 2% loss and move on to the next trade. It's when you risk 5%, 10%, 20% of your portfolio on one trade, that's when you can get yourself into some serious trouble. So let's say I have a $50,000 account for hypothetical reasons, and I'm going to select $1,000. I'm going to click on update, and this tool is going to find me in real time all the stocks that have generated that buy signal today and have credit spreads that generate more than 33% of the width. So as you can see, this column premium of width, that's going to tell me how much of the risk reward ratio I have on this specific trade. So Celsius Holdings is going to be the top one. I'm collecting 50% of the premium in terms of width. So that's a 1-to-1 risk reward ratio. That's actually really rare. We actually don't see that very often. So this is one that we'll take a look at here, right? So let's first take a look at a chart here for Celsius Holding. Let's just verify kind of what we're seeing here on the chart, right? So here's the chart. As you can see, clearly the stock is in an uptrend, right? And what we have and what we look for are these pullbacks, right? Pullbacks are kind of your opportunity to get long. And that's exactly what we're seeing here is these pullbacks. And what we're trying to capture are these moves to the upside, right? And I don't know that it's going to happen, that the next move is going to be higher, but statistically speaking, I'm putting everything in my favor, because everything I've shown you here before in terms of, these buy signals, right, is that you have to wait for pullbacks here, and then that gives you the potential for that next move higher in a quick move, right? And we've got that exact setup here in Celsius Holdings. We've got that exact setup in Celsius Holdings. And then what it's telling me, the stock is currently trading at 55. It's telling me to sell the 55 and buy the 51 strike expiring on October 31st, which is 45 days from expiration. And that will collect $2. Now, the distance between 55 and 51 is $4 wide. So if I collect $2, then I'm only risking $2. That's a 1-to-1 risk to reward ratio. So I have a really strong risk to reward ratio, and I have the chart set up that makes sense for now to be the right time to actually initiate that credit spread. So it does all of the work for me. So today, as you can see, I just clicked on a couple of buttons. I didn't have to look through hundreds of charts. I didn't have to pull up an options chain. It does all of the work for me. And what it does is it also accounts for the number of contracts, as you can see, for me to risk no more than $1,000. This is telling me that if I sell 5 contracts, my maximum risk on this particular trade will be $1,000. My max risk will be $1,000. My max reward will be $1,000. Okay. Now let's just take a look at the next one, Halliburton. Let's look at a chart here for Halliburton. Now, as you can see, Halliburton, this particular chart is not as attractive, right? It kind of, from an algorithmic perspective, makes sense, right? You wait for a bit of a pullback here, and these pullbacks are kind of the opportunities. This particular pullback isn't big, but it is a pullback in a minor uptrend. So this might not be the best possible setup here. And as you can see, this one is collecting 36% of the vertical width. So, it's greater than 33, but generally I try to get as close to 40% as possible on these types of credit spreads, right? So for me, I think I would just trade the Celsius holding ones and come back maybe a few hours later or maybe tomorrow and see what other scans come up. But this tool basically automates all of the work for you so that you just basically have to pick the ones at the top of the list. I always recommend taking a look at the chart, just making sure that you agree with the chart setup, right? And I think Celsius holding is probably one of the more obvious ones that you look at and you just say, yep, that ticks all the boxes. You have a clear uptrend. The stock recently broke out here from call it 35, 37, 35 bucks, right? The stock was range bound for quite some time, broke out, pulled back, came up again, pulled back, and I think we could potentially be heading for another move higher here, right? We'll just take a look at a few more charts and take a look at kind of what it looks like. Let's look at Las Vegas Sands. Another great example here, right? This is a stock that's clearly in an uptrend and recently has pulled back here, pulled back enough to potentially slingshot itself for the next move higher here. And Las Vegas Sands, let's look at this one, right? This is telling me to sell the 52.48. I'm collecting $1.45, which is 36% of the vertical width. That's a 1.8 to 1 risk reward ratio. So, it's better than 2 to 1. I really want to get as close to 1.5 to 1 as possible. On this one, I'm risking basically $765 to potentially make $435. That risk reward ratio is not as favorable to me as possible as I would like. So I would probably move on from that, right? So you can always use this as a way to do this. Now, I also do my own screening, right? And this is one of the most powerful parts about stock charts is that maybe you've built your own scans, right? So I've built some of my own scans and I've built some stocks that, I think are, let's look at my buy list, right? So I have a buy list of stocks. And this is automatically updated every single day using the advanced scheduled scans that I can run using Stockcharts, right? I use a bull put spread, 45 days. I'm going to select it $1,000 worth of risk. And you can run this same scan on your list as well, right? You don't have to just use our bullish trend following scan. If you built your own trend following scan, if you have your own trend following method, if you prefer, you have your own preference as far as what constitutes as a buy signal for you, you can always create those scans in stock charts, have those built into have those stocks put into a chart list. And then you can basically have the strategy center scan it against your own list of stocks. You don't have to just use it against ours. Ours are just a trend following scan built for you if you don't know how to build it yourself. But if you do use the tools within stock charts, which are incredibly powerful, and I really use them quite a bit, then you can do this on your own, right? Look at Moderna, right? Moderna, it collects 43% of the vertical width. But let's take a look at the chart here for Moderna. Now, my buy list is not a trend following buy list, right? My buy list is really a much different one, right? So this is one, as you can see, this is a stock that has been trading against this $25, $22 support level, right? You can call this a triple bottom or whatever you want to call it. But, this is basically a stock that has deteriorated, seemingly have found a bit of a bottom here, and we're looking for a potential upside here, right? I'm trying to pick bottoms here in this particular list, and this could be also a candidate for selling that credit spread. So it's just that, I just have built this as a different type of scan. Let's look at Trade Desk here. So what I'm trying to say is that this tool is incredibly powerful. You don't have to just use our trading signals. You can use your own trading signals. Here's Trading Desk, right? Trade Desk, as you can see, is kind of bottoming around this $45 mark. I'm in this particular trade, in this particular scan, I'm trying to find these stocks that are at its rock bottom, and I think these are opportunities to buy. And that's just the scan that I'm using here. But you can use it against any list of stocks that you want. So if you have built your own chart list of scans that you've built, you can put it into a chart list and you can use our tools to help you screen for it. And then basically you can then look for where can you get credit spreads that collect 40, 41, 43% of the vertical width. In this particular case, I would probably focus on these three opportunities, because these are three opportunities where I'm collecting 40, 41, 43% of the vertical width. That's where the options are skewed as heavily as favorable in my favor as possible. So that covers what I wanted to share with you here today, because my goal was to basically show you how you can find opportunities to best find these types of trade setups in real time without doing any additional work on your end. We've done all of the work for you. We've built these screeners. They are ready to go. You just have to click run, especially you just have to select the strategy, put in your max risk and click run, and it does it in real time. And sometimes you don't have any trades. Well, what you do is you come back tomorrow and you look for, but almost every single day, you're going to find at least one trading setup where the timing and the options are skewed, in your favor, and you can basically execute those trades at the midpoint, because these are all very liquid symbols that we are finding for you. And my goal here today was to show you a trading strategy where you can find the opportunities in the few clicks of the mouse. But it's not just you're not just following a strategy blindly. I'm hoping that today I've also taught you why these strategies work and why they're suitable for almost anyone, whether you're a beginner or an advanced trader, to get started with these ideas, because it's really important, if you want to grow your account in the long run, that you have a fundamental understanding as to why these strategies give you an edge. And hopefully today I illuminated why the options piece give you an edge, why the timing piece give you an edge, and how you can combine the two, and what tools can help you scan for these opportunities in real time. And this is just $40 a month as an add-on to your Stockcharts.com subscription. Top ranked strategies at your fingertips. It is going to save you hours and hours of time. We built this for myself as a trader. I used to do a lot of these screenings, the screening for the stocks manually. I'd build the screener, then I have to go through a list of stocks one by one, plugging them into a charting package like Stockcharts, validating whether I agree with that view or not. And then if I agreed with that view, then I have to pull up an options chain and manually search for that 45-day aggressive credit spread, then calculate how much the percentage of the width that I'm going to find. And as you can see, if I have a list of however number of stocks, as you can see, the vast majority of them don't come close to 40% of the vertical width, which means that if I was looking through this list manually and I had no idea which ones had the edge, 8 or 9 out of 10 stocks I looked at will have a credit spread that is below optimal or below what I'm really looking for, and only 2 or 3 out of the dozen or so have that edge. I spent a lot of time wasting looking for opportunities that just weren't there. We built this tool because I spent a lot of time wasting my time finding these opportunities, and we wanted a way to automate it. And after we built the tool, we partnered with Stockcharts just because I really like the capabilities that Stockcharts have in terms of screening and charting. And we just found that this was a really good partnership where you can get the best of both worlds, the best technical analysis tools with the best options tools. And when you combine those two into one, you get a really powerful screening capability that gives you the best possible trading setups in real time in under 2 seconds every single time you are ready to place a trade. It has saved me hours and hours of time of finding these opportunities. And I know every single time I click that mouse, in a single click, I'm going to find the best possible trading opportunities in the market. And you now have access to this tool as well. And what I want to do is I want to end this by showing you, once you get into one of these trades, how do you manage it, right? Because getting into trades is the easy part. Getting out of it takes a lot more work. So what I want to do is I want to show you a rules-based approach to managing these credit spreads. So the rule of thumb with these credit spreads is you have 3 possible triggers to exit a credit spread. You have a take profit rule, you have a stop loss rule, and you have a time-based rule. So it's a little bit more complicated, but basically you're looking for one of 3 things. If one of the 3 things trigger, you get out of the trade. So first of all, you want to exit the full position if you lose 100% of the max gain potential. What do I mean by that? If you sold a credit spread for $8, then the max gain potential on that credit spread is $8. So if you ever lose more than $8 on that credit spread, it's time to get out, right? So if you sold something for $8 and it's now trading at $16, meaning you've lost 100% of the max gain potential, it's time to get out of the trade. Cut your losses, move on to the next trade. On the flip side, if you sold something for $8 and it's now trading at $4, which means that you've made 50% of the max gain potential, it's time to take profits on that trade. Now, taking profits doesn't mean that you take profits and you walk away. Take profits could mean that you roll the trade and you basically look for further upside, right? You're using this tool to kind of help you find the new credit spread to sell on that same stock, right? You don't have to just take profits and move on. You can basically roll this and continue to try to capture more of the profits on that same stock because the directional view has kind of proven you to be correct. And now you just want to make more gains on that particular stock. So taking profits, you have a lot more choices. But when you have a stop loss, you should just get out and move on to the next stock. But when you take profits, you can continue rolling your profits into the next trade on that same stock to try to make even more profits on that particular trade. But with credit spreads, there's one time-based rule. Now, you can be flexible on this time-based rule, but what you want to do is you want to be consistent in your flexibility. What do I mean by that? So our goal when we're selling credit spreads is we sell a credit spread that's 45 days out. Once that credit spread ages to 21 days to expiration, you want to sell a new credit spread. You don't want to hold the credit spread in the last 2 to 3 weeks because that last 2 to 3 weeks, you're going to have what we consider acceleration in gamma risk. What that means is that even small movements in the underlying stock are going to cause significantly swings in the P&L of your strategy. So you could have a strategy that's solidly in the green, and a small move in the underlying is going to push that strategy into the red, or vice versa. So it could work in both ways, but generally speaking, we want to avoid that gamma risk that happens in the last 2 to 3 weeks, heading into expiration. So the rule of thumb that I usually place is roughly 21 days from expiration. You want to look at rolling your credit spread. But you can also choose 14 days or 7 days as long as you're consistent in your application of that, meaning you don't have to use 21 days. You can use 14 days, you can use 17 days, you can use 10 days, whatever you choose, just be consistent with it. I would say anywhere between 7 days and 21 days is okay. You generally want to be in the 14 to 21 day range, but if you want to go as short as 7 days, you can. But whatever you choose, just be consistent with it. So if you're going to stick to 7, every single time a credit spread gets to 7 days, you get yourself out. Well, that just means that if it gets to 7 days to expiration or 21 days or whichever one you choose, if it hasn't triggered your stop loss or take profit rule, you get yourself out based on a time-based rule. But chances are it'll trigger your stop loss or take profit rule before that time-based rule comes in. I would say the majority of the time you'll find yourself hitting that stop loss or that take profit before you hit that time-based rule. But if it does happen sometimes where it gets to that time-based rule without hitting your take profit or stop loss, it's time to roll your credit spread as well. So that's how you go about managing these trades once you are in them. Okay, so with that, that covers what I wanted to share with you here today. Like I said, this is a premium tool that costs $40 a month as part of your Stockcharts.com subscription. Hopefully today, I've shown you how to extract easily more than $40 a month of value out of this per month. You should be able to extract more than $40 worth of value on your first trade using this tool. You can sign up using the QR code here on your screen, or I can point you to the link here as well. 1 second. Here is the link, which I will post that link into the chat window for everyone to click on. If you want to either click on the link or use that QR code on your screen, that's where you can sign up for that add-on, which is, like I said, $40 a month. But I really hope that you extract a lot more value out of this just in time savings alone, if and nothing else, in helping you find these great trading setups or the most optimal trading setups every single time, so that you're not wasting time looking through dozens of charts and then pulling up dozens of options chains just to find these opportunities. You can do it in a couple of clicks in under 2 seconds and know that you're finding the best possible opportunities every single time you go and trade an option strategy. With that, let's open this up for Q&A. I'll answer a few questions before I have to sign off here today. There's a Q&A window and a chat window. If you can type your questions into the Q&A window, I will try to answer as many questions as possible. Okay, some great questions here so far. How do you interpret basis options play score for bullish trend? So the higher the options play score, the better. That's it. The options play score is just basically a risk to reward ratio. These are available in the replay as a replay. You will be able to find it under articles and videos. Under articles and videos, you have a section for options play, or actually you can just look for my name under articles and videos, and this will be available under my name. There's a great question here from saying, should we trade something if the volume or open interest is 0 or minimal? So, these are all very liquid stocks, right? So look at Robinhood, right? For example, Robinhood trades tens of millions of shares a day. So, the reason that the volume and open interest might be low is because a 45-day weekly option was probably just listed a few days ago. So options that were listed a few days ago obviously have very low open interest or volume, but it doesn't mean that it's not liquid. It just means that it was just listed. So there's fewer options or open contracts. Open interest and liquidity have very little to do with each other. What's a far better indicator is the bid-ask spread. The tighter the spread, the more liquid something is. The wider the spread, the less liquid something is. Think about SPY. SPY trades at a penny wide all day long. But if an SPY daily contract gets listed today, it's going to have an open interest of 0, right? Because it was just listed today, but it still trades at a penny wide. It is super, super liquid. So open interest and volume is usually not a very good indication of liquidity. The spread, the difference between the buy and the ask price, is going to give you a much better indication of how liquid something is. Because if something is very liquid, you have lots of market makers competing for your business, you're going to have very tight bid-ask spreads. And if you look at Robinhood, 970 by 995, that's a really tight spread on a $10 option. So from my perspective, always look at the bid-ask spread. That's going to much better sense for liquidity. Also, notice the stocks in the scan varies depending on the max risk. Not sure what you mean by that. The stocks vary based on the max risk. It's only going to pick stocks where the max risk is no more than 1,000, right? So if you look at American Express, it's over the max risk. So it's not going to even suggest you look at opportunities in American Express, because even a single contract pushes you above $1,000 worth of risk. So it's basically only going to help you. And this is one of the important tools when I say preventing you from blowing up your account, is using this max risk field. It's not even going to show you opportunities that are beyond your max risk. Can you address trade management issues to limit risk or capture majority gains? Hopefully I already, I think that question probably was posed before I went over the trade management slide. If you have any questions specifically around trade management, let me know. My question is, how do you handle the spread when the short strike moves in the money and the long call is out of the money? Do you roll up and out? How much do you appreciate it? So Rick, if you follow the trade management rules, right, meaning the stop loss, the take profit, and the time-based rules, you don't have to worry about, whether the stock is in between the spreads, out of the money, in the money. Like, all of that is sort of accounted for in that trade management rule. And the 21-day rule is specifically designed to avoid early assignment, exercise risk, assignment risk, all of those things that you're concerned about. Those things go out the door if you manage this based on a time-based rule. The whole point of the time-based rule is so that you never get to expiration and have that scenario where you're in between the two strike prices and one leg is in the money, the other leg is out of the money, and you can potentially have a scenario where you end up being long or short the stock. So the whole trade management rules is to avoid all of that. So there's a question here based, saying how many contracts is the $1,000 risk based on? It's calculated for every single strategy, right? So here, Moderna, right, $1,000 risk is going to be 5 contracts. Trade Desk is 4 contracts. Robinhood is 1 contract. Virtue Holdings is 1 contract. So it calculates for you the number of contracts. You see the number of contracts here, this column here. You put in the dollar amount and we will calculate the number of contracts based on that specific option that you're trading. And it's all calculated in real time. Can one do the same type strategy with cover calls and short puts? Absolutely. So if you want to look at the bullish trend, if you want to look at the bullish trend following list, and instead of selling debit spreads, you want to look at selling cover calls or short puts, you can do that, right? So let's look at selling put options. So our default for selling puts is 30-day aggressive. Bausch Health Co. This will, if you sold the $7 puts, you can sell 76 contracts of that. That's for $50,000 worth of risk. So you can select the appropriate number that you want to invest for that particular trade, and it will update for you for any of these strategies. You can look at long calls, long puts, debit spreads, credit spreads, iron condors, covered calls, short puts. These are all covered for you. I'm just showing you one strategy out of the 9 that are supported. So you can get a lot more value out of this tool than for $40 a month on what I'm showing you. I'm just showing you a single strategy that I think you're going to be able to extract way more than $40 worth of value that you're going to get from this just single strategy, but you're going to get all the other 8 strategies as well as part of your subscription. Please explain why you set the stop loss at 16. So generally speaking, if you've lost more than 100% of the maximum gain potential on a credit spread, the chances of you making any money on that trade is very low. And it's better for you to just cut your losses at that point rather than hold that position to max loss, right? So what I'm saying is that cut your losses at some point before you get to max loss. That's what I'm saying. And I'm saying that that threshold is around 100% of the max gain potential. So if you sold something for $8, 100% of that max gain potential is another $8. $8 plus $8 is the $16. This is where I put the stop loss. Can we see what the available trading strategies are other than credit spreads? Yeah. So here are the strategies: cover calls, short puts, long calls, long puts, debit spreads, credit spreads, and iron condors. Those are the supported strategies as part of the OptionsPlay add-on. What about nearing earnings report? Great question. That's why we have this field here on the right. It tells you whether or not there's an earnings coming up between now and the expiration date of the strategy. So let's go back to our scenario here of bull put spreads for bullish trend following. And I think the first one we looked at here before was Look at this. Celsius Holdings now is only 37% of the width, but UP FinTech Holdings is 45%, Bausch is 40%, Humana is 38%. That's how quickly options markets change. And that's why it's really important that we use tools like this to identify opportunities in real time. And out of all of these opportunities, as you can see, Humana doesn't have earnings. Bausch does have earnings. So this basically gives you an indication of whether there's earnings between now and the expiration date and when that earnings is, right? It'll tell you when the earnings date and whether there's an earnings coming up. Some people are comfortable trading these going into earnings. Some people aren't. So that earnings flag gives you an opportunity to see if there's earnings coming up. We basically try to account for all the things that you as an options trader care about and need to know before you execute this trade on your screen all at once, so that you don't have to go somewhere else to go finding that information, like when is the next earnings date? Is that going to be between now and the expiration date? This does all of that work for you. This tool currently does ETFs, liquid ETFs, and stocks. It does not do indices at the moment. It will do SPY or QQQ because those are obviously ETFs. Is there a directional strategy with simple calls and puts? Absolutely. If you just want to buy calls, you can do that. And it will also rank the calls based on which have the cheapest call options to buy as well. So if you prefer to just buy calls and puts, you absolutely can use this for that as well. When you take a risk of $1,000 and when you take $2,500 stocks are different. Yeah, because there are stocks that you can trade when you have $2,500 to risk, and that you can't trade when you only have $1,000 to risk. American Express was an example of that, right? That I just showed you, that if you were to, if you only had $1,000 to risk, American Express, even a single contract pushes you above that $1,000. But once you take $2,500, it's within the range. So that's why the stocks are different. Will there be webinars on other strategies? Yes, if you go to my name here under articles and videos, we actually have quite a few strategies that I've already covered in previous recordings. So, if you want to find out about how to use this tool for other strategies, we actually have a lot of videos already pre-recorded that you can go and watch that and see, how you can use this for other contracts as well. With that covers the questions that I see here in the Q&A section. Again, I really hope that this helps you understand, a single strategy that's going to help you grow your trading accounts in the long run. There's a lot of value that you can get out of this for $40 a month. And, even if you just sell cover calls, I always tell people you should be able to generate at least the first 2 to 3 months worth of your subscription value just on selling your first cover call using this tool. So if you have a list of stocks that you own in your portfolio in a chart list, right? So let's say, like for example, if I use my buy list, if that was the list of stocks that I owned, and I look at selling cover calls on that list, right? Just on the stocks and on the top stocks, right here, I'm collecting $61, $177, $63, $450. These are stocks that if I owned, that's how much I would generate in terms of income per 100 shares. If I owned all these stocks, I easily can generate, potentially the first year worth of my subscription value from just selling my first few cover calls alone. So like I said, you can get a ton of value from this for $40 a month. I hope you guys see some of that in today's session. And please, if you don't see enough value, go to some of our recordings and take a look at some of the opportunities that you can generate from selling cover calls and how you can pay for this, your first year of subscription and perhaps just the first month of selling cover calls. And then you can use these the tools for selling credit spreads essentially for free. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time.